2017, the total value of items held in stock was 50 million. During the month, the following transactions occurred. Okay, so we've got these transactions here, right? And then they say enter the above transaction in a store's ledger account, balancing off the account. Alright. Okay, so we have the first one here. We purchased materials purchased from suppliers on credit. Okay, so colleagues, okay, if we remember in financial accounting, okay, whenever there is a purchase, usually debit the purchase's expense and you credit the supplier. But in this case, you're not going to debit the purchase's expense. You're going to debit the store's account. They're showing that inventory has come in. Okay, colleagues? So you're going to debit the store's account. Treat the store's account like an asset account. It increases with debit. Whenever inventory comes in, the store's account is going to increase. Whenever the inventory moves out, the store's account is going to reduce. Are we okay, colleagues, with that? That's the trick here. If inventory is coming in, increase. Inventory going out, decrease. Okay. So here, purchase on credit. Okay, so inventory is coming in. They're going to debit the store's account. Say inventory has come in, which is we debited 60 million. Then, since we haven't paid out any money, we are owing. Okay, let me just put these double entry rules here. Yes. Since we never purchased cash, we are owing. So we've got a trade payable. A trade payable is a liability. Increasing a liability, you credit. Okay, so we are going to credit the trade payables 60 million. Increase in a liability. Any questions, colleagues? Most of you are thinking, double entry, no more. It's here, colleagues. It's here. Okay, we've got materials returned to suppliers. Okay, so here, from the store's account, it's going back to the supplier. So it means the store's account is dropping. Okay, so the store's account is like an asset account. Reduction in an asset, you credit. Since assets increase with the debit, so reduction is a credit. Since the inventory or the material is moving out of our stores. Okay, so you credit store's account. Okay. Then, since we bought goods on credit from our supplier, we're owing them money. But now, since we found some of the goods are bad and we returned it to the supplier, what happens to the money that we're owing the supplier, colleagues? What happens to the money that we're owing the supplier?
It reduces, sir.
Thank you. So we're going to debit trade payables. Remember, liabilities increase with credit. So reduction in a liability, you debit. So we're going to say debit trade payables. Accounts, remember this was return outwards. Do we remember that, colleagues? Return outwards? Yes. Materials purchased for cash 8 million. Okay. So here, materials are coming in, increase in the stores account, which is an asset account, you debit. Then cash again is also an asset account. So now since you're paying cash is reducing, and the reduction in an asset account you credit. So one asset account is increasing, the stores account. The other asset account is dropping, the cash account, because you are paying out money. So we're going to debit stores. $8 million, and we credit cash 8 million. Okay. Next, we got direct materials issued to production. Okay. So remember, colleagues, how the materials move: first stores, then work in progress, then finished goods. Okay. So work in progress again will also be treated like an asset account, and the finished goods account also be treated like an asset account. Okay. So remember, I moved from stores into work in progress, then finished goods. Okay, that's the sequence. Okay. So basically here the materials are transferring from one asset account to another asset account. Okay. So since they're leaving stores is an asset account. So you dash in an asset, you credit stores. Then they're going to work in progress, which is also an asset account. Increase in an asset account, you debit. Okay. So you debit work in progress. $55. And the credit stores 55. Colleagues, any questions so far? Are we okay? What's happening here? Feel free to ask where you've got questions. Materials issued to Maintenance Services Department. So colleagues, Maintenance Services, these guys do not take part in the actual production of goods or services. They just help in the daily operations of the business. Right? So remember, these maintenance services, these are the service departments. Okay. So we're going to debit production overheads. Okay. The materials are leaving the stores, going to production overheads, which are the services departments. Okay. So you're going to debit overheads, or production overheads. Now I'm yet to find out what type of account this is, so I'll let you know after I research. 20 million. And then stores, since it's leaving the stores account, so reduction in an asset. 20. Yes. Then finally, direct materials returned to stores from production. So they're coming back from work in progress. Okay, so since they're coming back from work in progress, work in progress is an asset. Reduction in an asset, you credit. So you credit work in progress. So from work in progress, they're coming back to the stores account. So stores account increase in an asset, you debit. So you debit stores account format 4 million. The receiving the inventory 4 million. And then you're going to credit work in progress. Work in progress 4 million. Any questions, colleagues? Before we now make the T account, balance it off. Okay, we make the T account. The stores ledger. Okay, so we have the debit side and the credit side. So earlier in the question they told us we had material worth 50 million sitting in the stores account. Okay. Stock worth 50 million. Okay. So since this is an asset account, so the balance brought down is 50 million here on the debit side. Okay, 50 million. Then we're going to start bringing in these entries now. Okay. So remember for our first transaction, we purchased materials on credit. We said debit stores 60 million. Okay. So we're going to this 60 million here. We're going to debit. Okay. Here under details, you're just going to put the other account that was involved here. Okay, trade payables. Then the next transaction where we changed to stores, we credited 3 million. So here on the credit side, again we put here trade payables, creditor 3 million. Then this one for where we bought material for cash, debit stores 8 million. So you're going to put here cash 8 million here, debit side. Here, when we sent the material from stores work in progress, we credited stores. Okay, so on the credit side, we put here work in progress, WIP, and we put 55 million. Okay. Then here, since the materials are taken to the service department, so we credited stores here 20 million. So we're going to put here production overheads. Production overheads 20 million. final transaction, goods are returned from work in progress back to stores. So we debit stores 4 million here. Details put work in progress 4 million. Okay. So we can now balance off the account. You see which one is bigger, the debit or credit side. In this case, it's the debit side that is big. Okay. You just add 50 plus 60 plus 8 plus 4, 122. So this amount you also put it here, 122. Okay. Then remember the balance carried down. Okay, you're just subtracting this, the total for the debit minus the total for the credit. Okay, let me just get the total for the credit. Total for credit, 78. So your balance carried down, total for debit minus total for credit, 44. So in the next month or the next year, this is the inventory that will be in the stores account. Inventory worth 44 million.